Hello everyone, I'm Lynn, and today we're diving deep into a stock that's been flying under the radar, but in my opinion, holds tremendous potential. And of course, very high risk. ESS Tech Inc., ticker symbol GWH. I know what you might be thinking. Lynn, another energy stock. Haven't we covered enough? But hear me out. ESS Tech is not your typical renewable energy play. They are tackling a massive challenge, long-duration energy storage, or LDES. Imagine a world where solar and wind power are available not just when the sun is shining or the wind is blowing, but 24/7. That's the promise of LDES. And ESS Tech, with its unique iron flow battery technology, is at the forefront. A quick disclaimer, this is a speculative buy. The risk is high, but the potential reward is equally high. If you can withstand volatility and have a long-term horizon, a deeper analysis reveals fascinating numbers behind this company. The core investment thesis, why ESS Tech could be a game changer. My research indicates a massive disconnect between ESS Tech's current market price and its intrinsic value. The current share price of GWH is approximately $4.16, but our target price is an astonishing $24.75. No, that's not a typo. And here is why. Deep value mispricing. My sum of the parts analysis suggests a base case intrinsic enterprise value exceeding $1.4 billion. In contrast, the current market capitalization is only around $59 million. The market is virtually pricing in failure, completely overlooking the immense potential upside, especially from their utility-scale energy center business. Technological differentiation. ESS uses a proprietary iron flow battery. Why is this important? It is inherently safer, more environmentally friendly, using abundant materials like iron, salt, and water, and perfectly suited for storage durations of 8 to 12 hours or even longer. While lithium-ion is great for short-term energy bursts, ESS's technology is the key to achieving true LDES. As renewables proliferate, this type of storage is not just a nice-to-have, it's non-negotiable. Rich catalyst pipeline. The company is at a critical inflection point. Yes, they face short-term liquidity and execution risks. However, over the next 6 to 18 months, we could see multiple significant catalysts: the SRP pilot project becoming operational, the conversion of the SMUD framework agreement into firm orders, and securing long-term financing. Any one of these could rapidly de-risk the company and trigger a market repricing. What is an iron flow battery? Simply put, unlike solid-state electrodes that degrade over time, flow batteries store energy in liquid electrolytes circulated between storage tanks via pumps. ESS Tech uses iron, salt, and water. This means scaling up only requires larger tanks, making it ideal for massive utility projects. Crucially, it bypasses the ethical and supply chain issues associated with materials like cobalt and lithium. This is also why tools like WorthMind are so powerful. They allow for systematic sum-of-the-parts valuation of complex companies, modeling different scenarios, bear, base, and bull, for a more robust valuation outcome. Now, to give you a clearer idea of how our valuation process actually works, let's take a look at the AlphaPilot valuation tool in action. This is the same tool we use for data analysis and value assessment in our reports, and it's what keeps our conclusions rigorous, consistent, and fully objective. We've always believed that transparency and advanced technology are the foundation of trust. So by showing you exactly how AlphaPilot operates, we hope you'll gain an even stronger sense of confidence in our analytical process. Sum of the parts valuation. To calculate the target price, we conducted an SOTP analysis, valuing each component of ESS's business separately. The results are as follows. Based on approximately 14.2 million fully diluted shares outstanding, this implies an intrinsic value of about $99.01 per share. No, that's too much for me. Lynn, $99.01? That's insane. Yes, it is. But this company faces real challenges. The gap between $99.01 and $4.16 is the market's fear of the execution chasm. As a hard tech startup, ESS faces fragile balance sheet, near zero cash by Q2 2025 projected, management test. Past leadership turnover, though the new COO focus on manufacturing is a positive. Moat in construction. Strong technology, but the true moat requires successful scaling, cost reduction, and order fulfillment. Given the severe liquidity, financing, operational, and commercial risks, we apply a 75% execution risk discount to the $99.01 figure. 99.01 times 1 minus 0.75 equals $24.75. This is our risk-adjusted price target, $24.75 per share. Recommendation: speculative buy on ESS Tech, GWH. 12 to 18-month price target, $24.75 per share. Target audience: only suitable for investors with a high risk tolerance and a long-term holding period. This is more of a venture capital style play within a diversified portfolio. The risk is total loss of capital, but the potential reward is extremely compelling. Key catalysts to watch: 0 to 6 months, SRP pilot progress, clarity on financing, especially large external funding, and FY26 guidance. 6 to 18 months, conversion of the SMUD framework agreement into firm orders, expansion of manufacturing capacity, and achieving positive gross margins. Successfully meeting these milestones would increase investment confidence. Delays or unfavorable financing terms would necessitate a reevaluation. That's my deep dive on ESS Tech. What are your thoughts? Are you bold enough to consider a speculative stock like this? Let me know in the comments and I'll link the full valuation report there. Also, tell me, which company should I value next? Don't forget to like, subscribe, and hit that notification bell so you don't miss my next analysis. See you next time.